Every one of us can remember a time we lost money, whether it was a poor investment decision or lending money to your deadbeat brother. We all know the painful realization that sets in when you realize that money's gone forever. Now, how would you feel if the amount you lost was hundreds of millions of dollars? Today, that painful feeling is hitting particularly hard for tech startups with the collapse of Silicon Valley Bank, formerly the 16th largest bank in the United States with $175 billion in deposits. We don't know the true scale of the losses yet, but streaming platform Roku has already disclosed it had $487 million at SVB, and the gaming giant Roblox had $150 million in deposits. While these companies will likely not lose all of their deposits, from the hundreds of millions of dollars they are owed, only $250,000 per company is guaranteed to be returned. In this video, I'm going to provide a brief summary of the Silicon Valley Bank collapse, explain why most of these deposits were not protected, and explain what insured cash sweeps are and how they could have saved customers' deposits. If I had to sum up why SVB collapsed in one sentence, I would say it was a classic run on the bank. At least that is what put the final nail in SVB's coffin, but the bank had been digging its own grave for some time. When interest rates were near zero, SVB bought 10-year U.S. Treasuries as a place to park and preserve their deposits. The yield on those bonds was very low at the time. As interest rates began to rise, those 10-year bonds became much less attractive to investors. Rates rising also heavily impacted SVB's main customers, tech startups. As funding for these startups started drying up, they began drawing down on their deposits at SVB. To cover its customers' increased need for liquidity, SVB sold a $21 billion bond portfolio. The portfolio consisted mainly of U.S. Treasuries and had only been yielding 1.79% versus the current 10-year Treasury yield of 3.9%. As a result, SVB was forced to sell the bonds at a $1.8 billion loss. The bank then needed to cover this loss by raising capital. On March 9, 2023, it announced it would sell $2.25 billion in stock to cover the loss. The bank's shares plummeted. Several major venture capital firms told the startups in their portfolio to get their deposits out. Rumors of a collapse spread, and we ended up with a good old-fashioned run on the bank. This promised the Federal Deposit Insurance Corporation, known as the FDIC, to take over Silicon Valley Bank the following day. The FDIC is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. In addition to insuring deposits, the FDIC examines and supervises financial institutions for safety, soundness, and consumer protection. It also manages receiverships when they need to step in and save a failing bank like SVB. If you have a bank account in the United States, you likely have heard of the FDIC. Most people know it for its deposit insurance. For deposits held at a U.S. bank, customers receive insurance on those deposits backed by the United States government with protection up to $250,000 per person per bank. So what insurance do massive companies depositing hundreds of millions of dollars receive from the FDIC? They also get $250,000 worth of coverage. That's right, Roku's $480 million account has the same FDIC coverage as your $487 bank account. Every corporation has the same FDIC insurance per bank that consumers do. Given the low insurance amount, how could the companies exposed to the SVB collapse done a better job protecting their deposits? The Insured Cash Sweep, or ICS for short, is used by banks and credit unions to protect deposits. Large deposits can be split up and distributed across many FDIC-insured banks in the ICS network, so each bank account only holds a maximum of $250,000. This means all of your deposits are insured, you can earn interest, and all the management is done by the bank, so transactionally it's the same as if you kept your deposits at one bank. No ICS depositor has ever lost money. Every time an ICS bank has failed, all claims have been paid by the FDIC. The Insured Cash Sweep service is run by IntraFi Network. There are over 3,000 member banks, so theoretically one company could have deposits up to $750 million. SVB did offer cash sweep services, but it seems like they forgot about the insured part. Their cash sweep service seems to have moved deposits into money market funds from BlackRock, Morgan Stanley, and Western Asset. These funds would only have been eligible for the standard $250,000 in FDIC insurance. There seems to be a lot of negativity towards the Federal Reserve for raising rates in a lot of the coverage I have seen on the SVB collapse. But these are necessary actions to curb the aggressive inflation we are finally experiencing after over a decade of liquidity being pumped into the financial system. The United States and the world have become drunk on low interest rates. The venture capital firms who would not help capitalize SVB last week are now begging the government for a bailout. It seems like everybody involved wants capitalism on the way up and socialism on the way down. This will likely be the first of many more investor hangovers to come. Although I am in the market to buy a bank, even at its heavily reduced valuation, the SVB is far too expensive for me. I would also like to find a bank with a loyal customer base, something more along the lines of the customers in It's a Wonderful Life rather than the customers in the Social Network movie. You can learn more about my plan to buy a bank by watching my insane financial goals. I would love to hear your thoughts on the SVB collapse. Do you think there will be a bailout? Comment below and deposit a click in the subscribe button.